How to profit using the 1, 2, 3, 4 trading strategy. The 1, 2, 3, 4 trading strategy is a trend reversal pattern that signals a possible change in market direction. The pattern consists of 4 distinct price points that develop after an existing trend begins to lose momentum. Rather than trying to predict the exact top or bottom of a trend, traders wait for confirmation that buyers or sellers have gained control before entering a position. This confirmation helps reduce false signals and improves the probability of entering a successful trade. The strategy works equally well in bullish and bearish markets because every financial market moves in cycles. Trends eventually slow down, reverse, and begin moving in the opposite direction. The 1, 2, 3, 4 pattern helps traders recognize these turning points. Financial markets move in cycles. Trends rarely continue forever because buyers and sellers constantly compete for control. Eventually, momentum weakens, profit-taking begins, and new participants enter the market at different price levels. The 1, 2, 3, 4 strategy works because it helps traders recognize this shift in market sentiment. Instead of trying to predict reversals too early, traders wait until the market confirms that buying or selling pressure has actually changed. This confirmation-based approach reduces emotional decision-making and increases the probability of entering trades with favorable momentum. Just a quick reminder to please hit the like button and subscribe to the channel for more great content like this. Also, you can visit us on the web at investmenttees.com and use code BLOG to receive 20% off your next purchase. The 4 stages of the pattern. Understanding each stage is the key to successfully applying this trading strategy. Point 1 marks the end of the current trend. In a downtrend, it is the lowest low before prices begin to recover. In an uptrend, it is the highest high before prices start falling. Point 2 represents the first significant move in the opposite direction. This move suggests that momentum may be changing. Point 3 is the pullback. The market retraces but fails to make a new high or low. This failure indicates that the previous trend is weakening. Point 4 is the confirmation. Price breaks beyond point 2, confirming that the new trend may be underway. Only after point 4 forms do most experienced traders consider entering the trade. How a bullish 1, 2, 3, 4 pattern forms. Imagine a stock has been declining for several weeks. Eventually, the selling pressure slows, and the stock reaches its lowest point. This becomes point 1. Buyers step in, pushing the price higher to create point 2. The stock then pulls back but remains above point 1, forming point 3. Finally, buyers return with enough strength to push the price above point 2. This breakout creates point 4, confirming a bullish reversal. At this stage, many traders open a long position because the market has demonstrated increasing buying pressure. How a bearish 1, 2, 3, 4 pattern forms. The bearish version follows the same logic in reverse. After a strong uptrend, the market reaches a high, which becomes point 1. Prices decline to point 2 before attempting another rally. However, the rally fails to create a new high and forms point 3. When prices fall below point 2, point 4 is confirmed, signaling that sellers have gained control. This creates a potential short selling opportunity or a signal to exit existing long positions. The primary objective is to enter a trade shortly after the new trend has been confirmed while limiting downside risk. Once the breakout above or below point 2 occurs, traders place their entry orders. A stop loss is typically positioned just beyond point 3 because a move beyond this level invalidates the pattern. Many traders target a reward that is at least twice the amount they risk. This favorable risk-to-reward ratio allows traders to remain profitable even if only half of their trades are successful. For example, If a trader risks $100 on a trade, they may aim to make $200 or $300. Over time, maintaining disciplined risk management can produce consistent returns. The 1, 2, 3, 4 trading strategy example. Imagine that a stock has been falling steadily from $100 to $80. At $80, selling pressure begins to weaken. This becomes point 1. The stock then rallies to $87. This forms point 2. Next, the price pulls back to $83 but does not fall below the previous low of $80. This creates point 3, which indicates buyers are beginning to defend higher prices. Finally, the stock rises above $87 and closes at $89. This breakout becomes point 4 and confirms the bullish reversal. A trader enters a long position around $89 with a stop loss below $83. If the trader risks $6 per share, they may target a gain of $12 or even $18, depending on their preferred risk-to-reward ratio. If the stock eventually reaches $101, the trader earns a solid profit while maintaining disciplined risk management throughout the trade. The 1, 2, 3, 4 trading strategy is remarkably versatile. Stock traders use it to identify trend reversals after earnings announcements or major news events. Forex traders apply it to major currency pairs because of their strong liquidity and continuous price movements. Cryptocurrency traders frequently use it because digital assets often experience significant momentum shifts. Commodity traders rely on the strategy for markets such as gold, crude oil, and silver. Index traders also benefit from the strategy during broad market reversals. Because it is based entirely on price action, the strategy works wherever trends exist. One of the greatest strengths of the 1, 2, 3, 4 strategy is that it adapts to different trading styles. Day traders often use 1-minute, 5-minute, or 15-minute charts. Swing traders typically prefer 4-hour or daily charts because they reduce market noise. Long-term investors may even use weekly charts to identify major trend reversals. Regardless of the time frame, the pattern itself remains exactly the same. Conclusion: the 1, 2, 3, 4 trading strategy is a practical and disciplined price action method that helps traders identify potential trend reversals with greater confidence. By waiting for 4 distinct price points and confirming a breakout before entering a trade, traders can reduce emotional decision-making and improve the quality of their entries. The strategy is simple enough for beginners to understand while remaining effective enough for experienced traders to incorporate into more advanced trading systems. Success with the 1, 2, 3, 4 trading strategy depends not only on recognizing the pattern but also on practicing patience, applying proper risk management, and maintaining consistent discipline. When combined with sound trading principles and a favorable risk-to-reward ratio, this strategy can become a valuable addition to any trader's toolkit. As with any trading method, practicing on historical charts or a demo account before risking real capital can help build confidence and improve long-term performance. Thank you for watching.